Hello, and welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoen. Today we have a packed agenda with some major developments in the Canadian mortgage and real estate sectors. From inflation rates and economic outlooks to significant industry acquisitions and the latest trends among first-time homebuyers, we have got it all covered for you. So, without further ado, let us dive into our first segment. Canada's annual inflation rate unexpectedly ticked higher in May, raising doubts about what the Bank of Canada will do when it makes its next interest rate decision in July. Statistics Canada reported that the annual inflation rate rose to 2.9% in May, compared with 2.7% in April. This increase follows a decision by the Bank of Canada to cut its benchmark interest rate by 0.25 percentage point earlier this month to 4.75%. TD Bank senior economist James Orlando called the inflation report a disappointment, as both core and overall inflation rose higher. Now, one bad inflation print does not make a trend, and inflation remained below 3%, Orlando wrote in a report. But it does speak to the unevenness of the path back to 2%. For this reason, we think the Bank of Canada will likely pause at its July meeting before cutting rates again in September. The Bank of Canada's next rate decision is set for July 24th, when it will also publish its latest outlook for the economy in its monetary policy report. Following the inflation report, financial markets suggested the odds that the central bank would cut rates in July were lower. However, Olivia Cross, North America economist at Capital Economics, noted that some of the strength in inflation was due to factors that are likely to be one-offs. Given there is another inflation report before the late July meeting, she stuck with her view that the bank will cut again next month. While the latest release does increase the chances of the bank pausing at its July meeting, the other major data releases before then, including the June CPI release, could sway the bank's thinking, Cross wrote. In addition to the June inflation figures, Statistics Canada will release its gross domestic product figures for April and its labor force survey for June. The Bank of Canada will also release its own Business Outlook Survey and Canadian Survey of Consumer Expectations on July 15th. Don Desjardins, chief economist at Deloitte Canada, said the central bank will be scrutinizing the upcoming data. They themselves have really said it is going to be bumpy and choppy, Desjardins said of the Bank of Canada. But overall, is it enough to say, okay, we need to really step back completely from rate reductions? I do not think so. A summary of the deliberations by the Bank of Canada's Governing Council regarding its June rate decision suggested the central bank considered waiting until July to lower interest rates, but ultimately decided to cut earlier. While they recognized the risk that progress could stall, as it had in the United States, there was consensus that with 4 consecutive months of easing in core inflation and indicators suggesting continued downward momentum, there had been sufficient progress to warrant a first cut in the policy rate, the summary said. Statistics Canada said Tuesday, the overall increase for May came as prices for services rose 4.6% from a year ago, up from a 4.2% increase in April. Prices for goods grew at the same rate as April at 1%. Mortgage interest costs were up 23.3% compared with a year ago, while rent prices were up 8.9%. Prices in May for travel tours rose 6.9% compared with a year ago, while air transportation prices increased 4.5%. Gasoline prices were up 5.6% compared with a year ago. Grocery prices rose 1.5% year over year in May, a tick higher compared with April, when they rose 1.4%. It is the first acceleration in grocery prices since June last year. However, Statistics Canada said consumers are paying 22.5% more for groceries compared with May 2020. Bank of Canada. Governor Tiff Macklem has expressed optimism that the Canadian economy can achieve a soft landing where inflation slows without a significant increase in unemployment. Speaking in Winnipeg on Monday, Macklem emphasized that an unemployment spike is not necessary to reach the central bank's 2% inflation target. Macklem noted that Canada's current unemployment rate of 6.2% is just above pre-pandemic levels, which he described as close to maximum sustainable employment. He explained that the labor market has loosened and is closer to being in balance. While it is becoming harder to find new jobs, this issue is particularly affecting young workers and newcomers, whose unemployment rates are rising faster than those of other Canadians. The governor's comments suggest a growing confidence that the labor market has eased enough to allow further cooling of inflation while maintaining economic growth. In a post-speech press conference, Macklem hinted at the possibility of future interest rate cuts if price pressures continue to decrease. "We do not want monetary policy to be more restrictive than it has to be," Macklem said. However, he cautioned against lowering borrowing costs too quickly and risking progress on inflation control. Addressing wage growth, Macklem noted that while it remains above pre-pandemic levels, the rebalancing of the labor market and lower inflation are beginning to moderate compensation pressures. He expects wage growth to further moderate in the future. Macklem also commented on immigration, suggesting that the federal government has some leeway to slow the growth of non-permanent residents without causing labor shortages. While acknowledging the importance of immigration as a key source of growth, he noted, there are limits to how quickly we can absorb people into the economy. Looking ahead, Macklem emphasized the need for long-term investments in an inclusive labor market, smart immigration, and a robust education system to address Canada's productivity challenges. A significant development in the Canadian mortgage industry occurred recently when Nesto, a digital mortgage giant, announced its acquisition of CMLS Financial. This deal, which was long rumored and has now come to fruition, marks a major step for Nesto as it continues to expand its footprint in the broker channel. The acquisition comes on the heels of Nesto's earlier move to roll out its products to select brokers through a partnership with the M3 network. The acquisition will bring together more than 1,000 employees and over $60 billion in mortgages under administration. This large-scale integration was facilitated by investors such as Diagram Ventures, National Bank's corporate venture capital arm, NaVentures, BMO Capital Partners, and Fonds de Solidarité FTQ. Malik Yacoubi, the chief executive officer of Nesto, explained that the deal would significantly expand the company's reach in the broker space and introduce it to the commercial lending sector for the first time. CMLS Financial has a long-standing reputation in the broker channel, which Yacoubi highlighted as a key factor in the acquisition. CMLS is a really well-established brand in the broker channel, Yacoubi said. This is something that we like, as it brings strong origination from that channel, which is an important channel for Canadians. We were not in the commercial space either, so adding the whole commercial multifamily expertise from CMLS really is making a great difference. Yacoubi also emphasized the cultural fit between the two companies, noting that discussions had been ongoing for nearly a year. He pointed out the similarities between CMLS's Intellify division and Nesto's Mortgage Cloud offering. The merger aims to leverage technology from both sides to create what Yacoubi described as the mortgage ecosystem of the future. This ecosystem will connect and leverage the various actors already involved in the mortgage process, enhancing the strong relationships that both Nesto and CMLS have established. The merger promises to capture more market share and create numerous opportunities by connecting all distribution channels with robust servicing platforms and a strong investor base. All this feeds into a really strong book on mortgage, and from a back-end perspective, there are all the capital market actors that are funding these mortgages, Yacoubi explained. So having the ability to connect all these distribution channels with strong servicing platforms and a strong investor base will just generate opportunities for everyone. It is about enabling the data flow to surface opportunities for all parties involved. Nesto's move into the broker channel was a strategic decision that had been long anticipated. Yacoubi mentioned that the company always planned to work with brokers, and the acquisition of CMLS now brings that plan to a larger scale. Interestingly, the purchase will see the Nesto, CMLS, and Intellify brands remain separate, with no current plans to merge into a single unified brand. Despite the sluggish performance of Canada's mortgage and housing markets in 2024, largely due to high interest rates and an affordability crisis in many urban centers, Yacoubi remains optimistic about future prospects. He suggested that the Bank of Canada's interest rate cut at the beginning of June could serve as a catalyst for increased market activity in the latter half of the year. "We see the volume is picking up. We see a good trend right now," he said. "And so, we're really positive about the market for the back half of the year. The rate cut is helping from a psychological perspective for Canadian consumers. Yakubi also noted the upcoming wave of mortgage renewals as a significant opportunity for Nesto. We're excited about what's coming in, the fact that there are so many consumers coming up for renewal in the coming months and years. So for us, we just see that as an opportunity to bring more options to Canadians. We're really positive about what's about to come in the market. The Canadian mortgage industry is buzzing with excitement as Canadian Mortgage Professional has just unveiled its list of rising stars for 2024. Now in its sixth year, this highly anticipated report highlights the best and brightest young talent who are making significant strides in the mortgage space across Canada. These individuals, all age 35 or under as of June 30th, 2024, have demonstrated exceptional achievements and promise, ensuring the industry is in capable hands as it moves forward. Earlier this year, Canadian Mortgage Professional called on the mortgage community to nominate its standout young professionals. The criteria for nominations were clear. Nominees had to be 35 years old or younger, have a proven track record of accomplishments in the mortgage industry, and must not have been previously recognized in the Rising Stars or Young Guns awards. The response was overwhelming, with numerous nominations pouring in from across the country. Nominees were asked to provide detailed information about their current roles and responsibilities, as well as their key achievements over the past year. In addition to self-reported data, recommendations from managers and senior industry professionals played a crucial role in the selection process. After a thorough review of all submissions, Canadian Mortgage Professional narrowed the list down to 40 outstanding individuals. This year's list of rising stars is a testament to the integrity, relationship-building abilities, innovative approaches, and exceptional customer service skills of the industry's young talent. These qualities are essential for navigating the complex and ever-changing landscape of the mortgage industry. The 2024 Rising Stars are not just excelling in their current roles, but are also setting new standards for what it means to be a successful mortgage professional. Among the notable names on this year's list are Tom Hall from Blue Mortgage, Sean-Mark Mello from Lendwire Incorporated, and Hannah Martins from Mortgage Alliance. Each of these individuals has shown remarkable skill and dedication in their respective roles, contributing to their company's success in the broader mortgage industry. Tom Hall, for instance, has been instrumental in developing innovative solutions at Blue Mortgage, helping to streamline processes and improve client experiences. Sean-Mark Mello at Lendwire Incorporated has been recognized for his exceptional relationship-building skills and his ability to close complex deals efficiently. Meanwhile, Hannah Martins at Mortgage Alliance has earned accolades for her customer-centric approach and her knack for finding the best mortgage solutions for her clients. These rising stars, along with the other talented professionals on the list, represent the future of the Canadian mortgage industry. Their achievements over the past year are a clear indication that the industry is evolving, with a new generation of leaders poised to take it to new heights. For those interested in learning more about the other top young mortgage professionals who made the cut, the full report is available for free on the Canadian Mortgage Professional website. As we look to the future, it is inspiring to see such a diverse group of young professionals making their mark in the mortgage industry. Their dedication, innovation, and commitment to excellence are exactly what the industry needs to navigate the challenges and opportunities that lie ahead. Congratulations to all the rising stars of 2024. Your hard work and achievements are truly commendable. Our final segment today focuses on a recent report that sheds light on the financial challenges faced by first-time homebuyers in Ontario. According to a report from CIBC, more than one-third of first-time homebuyers in Ontario are receiving financial assistance with their down payments. This assistance often comes in the form of gifts, with the average gift amount now standing at a staggering $128,000. The report, authored by CIBC economists Benjamin Tal and Catherine Judge, reveals that approximately 36% of first-time homebuyers in Ontario are using gifts to cover all or part of their down payments. This is 5% higher than the national average and represents a significant increase from a similar study conducted in 2021. At that time, only about 31% of first-time homebuyers in Ontario were receiving such gifts. Interestingly, Ontario is not the only province where this trend is prevalent. In British Columbia, the average gift amount for first-time homebuyers is even higher, reaching $204,000. The Ontario figure has risen by 52% over the last 5 years, while the number in British Columbia has surged by an astonishing 90%. The CIBC report suggests that these financial gifts are helping to mitigate the impact of housing inflation for buyers. However, it also notes that this trend is contributing to a widening wealth gap in Canada. The report states, homebuyers relying on a wealth transfer from their parents in order to purchase a home is becoming the norm, especially in the country's most expensive real estate markets. The average price of a home in Toronto was $165,691 in May, which actually represented a 2.5% decline from the same time last year. However, higher interest rates have increased the cost of borrowing, further deteriorating affordability. The report highlights that gifts have a strong correlation with home prices, although gift amounts have continued to rise despite the drop in home prices since 2021. While the benchmark home price has fallen by 14% since its peak during the COVID-19 pandemic, prices are still 33% above pre-pandemic levels. This means that gift amounts have risen faster than home prices over the same period. The report concludes that while these gifts are providing crucial support for first-time homebuyers, they are also contributing to higher home prices and increased wealth disparity. This phenomenon of gifting down payments is undoubtedly having a significant impact on the housing market in Ontario and beyond. It is a double-edged sword, offering essential financial support to first-time buyers, while also exacerbating existing inequalities. As we continue to monitor these trends, it will be interesting to see how they evolve and what measures, if any, are taken to address the growing wealth gap. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussions insightful and informative. As always, we aim to keep you updated on the latest developments in the mortgage and real estate sectors. Thank you for tuning in, and we look forward to bringing you more expert analysis and industry news in our next episode. Until then, I am Steve Hamoen, signing off. Have a great day.